Financial scandals have an uncanny ability to captivate our collective attention. They are not just tales of corporate wrongdoing. They are the narratives of human ambition, deception, and sometimes breathtaking recklessness. These scandals leave an indelible mark on our financial and cultural landscapes. In this video, we will embark on a journey through some of the most notorious financial scandals in recent history, exploring their causes, consequences, and the enduring lessons they have imparted to our society. The Enron Scandal, 2001, a mirage of prosperity unveiled. The Enron Scandal, one of the most infamous financial debacles of the 21st century, serves as an eye-opener into the dark underbelly of corporate America. At its zenith, Enron was perceived as an energy powerhouse, but behind the scenes, its executives were manipulating the books to hide crippling debts and report fictitious profits. CEO Jeffrey Skilling and CFO Andrew Fastow played a pivotal role in this deception. They employed a complex web of off-balance sheet entities known as special purpose vehicles, SPVs, to disguise the debt load. The result was a mirage of financial prosperity, causing Enron's stock price to soar. However, when the fraudulent scheme unraveled, the consequences were catastrophic. Enron filed for bankruptcy, making it one of the most significant corporate collapses in US history. Thousands of employees lost their jobs, and their retirement savings evaporated. Investors suffered enormous losses. The Enron scandal was a rude awakening, revealing the critical need for more robust corporate governance, transparency, and accountability. The Bernie Madoff Ponzi Scheme, 2008, The Wizard of Lies.
Fixture on Wall Street, Bernie Madoff, 70 years old, arrested by the FBI.
The Bernie Madoff Ponzi scheme is a modern financial tragedy of Shakespearean proportions. Over more than 2 decades, Madoff orchestrated a colossal deception that ensnared wealthy individuals, charities, and even celebrities like Holocaust survivor Elie Wiesel. Madoff promised high and consistent returns to investors, but in reality, he was using new investments to pay off earlier investors, creating a classic Ponzi scheme. The magnitude of this fraud is staggering, with estimated losses reaching $65 billion. When the scheme finally collapsed in 2008, Madoff confessed to his sons, and the full extent of his deception became apparent. Madoff was sentenced to 150 years in prison, but the damage was already done. The Bernie Madoff case stands as a stark reminder of the dangers of unchecked financial fraud and the importance of robust regulatory oversight. WorldCom 2002, Creative Accounting Unmasked. WorldCom's fraud was a prime example of creative accounting gone awry. The company's CFO, Scott Sullivan, and controller, David Myers, engaged in fraudulent accounting entries to hide operating expenses and inflate profits. The heart of the scheme was capitalizing costs that should have been treated as regular expenses, effectively inflating the company's balance sheet. When the fraud was discovered, it amounted to approximately $11 billion. WorldCom's bankruptcy marked one of the largest in US history. Shareholders and employees suffered significant losses. This scandal underscored the vital importance of rigorous accounting oversight, transparency, and the need for accurate financial reporting. Volkswagen Emissions Scandal, 2015, a blemish on an automotive giant. The Volkswagen emissions scandal was a stark reminder of the potential for deception within even the most reputable organizations. Volkswagen, a global automotive behemoth, was discovered to have installed defeat devices in its diesel cars. These devices were designed to cheat emissions tests. During testing, the cars appeared to meet emission standards, but in real-world driving, they emitted pollutants far above legal limits. The consequences of this scandal were profound. Volkswagen had to undertake extensive recalls and settlements, ultimately costing the company over $30 billion in fines and legal actions. Its reputation suffered a significant blow, and Martin Winterkorn, Volkswagen's CEO at the time, resigned. This case highlighted the need for transparent and environmentally responsible corporate practices, as well as the importance of upholding ethical standards in all aspects of business. Lehman Brothers 2008, the tipping point of a global crisis. The collapse of Lehman Brothers during the 2008 financial crisis was a pivotal moment that sent shockwaves through the global financial system. Lehman Brothers, a major investment bank, was deeply embroiled in the subprime mortgage market, with risky investments that led to substantial losses and a liquidity crisis. The US government's decision not to bail out Lehman Brothers was a pivotal event during the financial crisis. The bankruptcy of this institution is often considered the tipping point that exacerbated the economic downturn. It caused panic in the global financial markets, eventually contributing to a deep and widespread recession. The Lehman Brothers case highlighted the critical need for robust financial regulations, oversight, and effective risk management in the banking sector. Satyam Computer Services, 2009, India's wake-up call. The Satyam scandal, which unfolded in 2009, was a wake-up call for India's corporate sector. Satyam Computer Services, one of India's largest IT services companies, became embroiled in a massive fraud orchestrated by its founder and chairman, Ramalinga Raju. Raju confessed to fabricating revenue, inflating assets, and understating liabilities, causing $1 billion fraud. The scandal not only shook investor confidence, but also shone a spotlight on corporate governance practices in India. The Indian government intervened, appointed new leadership, and embarked on an extensive rescue mission to salvage the company. The Satyam scandal emphasized the importance of strong corporate governance, transparency, and accountability, not only in India, but globally. Health South Corporation 2003, Healthcare's financial fiasco. The Health South Corporation scandal in 2003 was a striking example of how even the healthcare sector could be a breeding ground for financial misconduct. CEO Richard Scrushy and other executives engaged in widespread manipulation of the company's financial statements, inflating earnings by approximately $2.7 billion. The fraud included fictitious revenues, earnings, and manipulated balance sheets. Scrushy faced legal action and was eventually convicted and sentenced to prison. The Health South case underscored the significance of robust corporate governance and internal controls, particularly in industries as sensitive as healthcare. Barings Bank 1995, the rogue traders' catastrophe. The collapse of Barings Bank in 1995 serves as a classic case study on the risks associated with rogue trading. Unauthorized trading by Nick Leeson, a trader based in Singapore, led to massive losses that exceeded the bank's entire capital. Leeson made speculative and unauthorized trades on futures contracts, particularly on the Nikkei 225 index. The losses were staggering, and Leeson fled, but he was eventually captured and imprisoned. The Barings Bank collapse highlighted the need for stringent risk management and internal controls within financial institutions. AIG Financial Products, 2008, the complexity of global finance. AIG's Financial Products division was at the epicenter of the 2008 financial crisis due to its involvement in the issuance of credit default swaps, CDS, on mortgage-backed securities. When the housing market crashed and mortgage defaults surged, AIG faced significant collateral calls from its counterparties. To prevent AIG's collapse, the US government intervened with a bailout package of approximately $180 billion. This case illuminated the complexity and interconnections within the global financial system and underscored the risks associated with excessive risk-taking in financial markets. Zhang Shuhong and Mattel, 2007, a toy's safety unveiled. The Zhang Shuhong and Mattel case in 2007 raised critical concerns about product safety standards. Zhang Shuhong, a Chinese manufacturer, found to have used lead paint in toys, some of which were sold under the Mattel-owned Fisher-Price brand. This discovery raised significant safety issues for children. Mattel was compelled to recall millions of toys, and the incident prompted increased scrutiny of product safety standards in the toy industry and global supply chains. This case highlighted the importance of stringent quality control and safety standards in manufacturing and product sourcing. Conclusion: lessons learned and reforms undertaken. These financial scandals, though diverse in their nature and impact, share common threads of deception, mismanagement, and ethical lapses. They serve as poignant reminders of the critical need for transparency, accountability, and effective regulatory oversight in the corporate world. In response to these scandals, significant reforms and tighter regulations have been introduced to safeguard against such occurrences in the future. The Sarbanes-Oxley Act emerged from the ashes of the Enron scandal, introducing stricter accounting and governance regulations. The global financial crisis of 2008 prompted extensive regulatory reforms to prevent a recurrence of Lehman Brothers' collapse. These cases have also left enduring lessons in their wake. They underscore the importance of ethical business practices, transparency in financial reporting, and stringent internal controls. They serve as a call to vigilance for governments, regulators, and investors, urging them to remain watchful against the emergence of future financial scandals. As we reflect on these notorious financial scandals, we must remember that they are not just tales of corporate wrongdoing, they are cautionary tales, reminding us that the cost of unethical behavior and lax oversight can be monumental. By learning from these examples, we can better equip ourselves to prevent such incidents and protect the integrity of our financial systems and markets.